Hey, good afternoon, guys. This is Chills and Day here with Chrono Historia. Today we're going to be talking about what actually happens when a stock's price falls to zero. There's a lot of false information out there revolving around this concept because a lot of people just haven't dealt with this before. Uh, a majority of investors get out of an investment before it's actually worthless. Um, but if you're one of those people who end up holding the bags when everyone else flees, and you have a company that's it's worth near zero, then this is completely for you. It's not a bad sign. Depends on the company. You got to be like do your due diligence on it. But essentially, why this article is important is because when a company is under a regulation set price and doesn't hit criteria to remain compliant on an exchange, they will panic. They will begin doing things that indicate they're failing internally as a company before any sort of report hits the street. And you can short it. You can make a lot of money off of following these companies around. I know a ton of vultures. Well, they're called vulture firms, but they basically find these failing companies and they gut them for everything they're worth. Um, and you can mimic their methodology as an investor, and they'll make like 30-40% in a year. Uh, Granted, it's a risky strategy and involves a lot of legwork and research, but you can do it. So let's jump right into the article. So yeah, when a stock's price falls to zero, obviously it's worthless. Stock can never actually be worth $0 because the tangible book value always, as long as the company has like a chair or a computer or some sort of asset to its name, it's worth something. It might only be worth $1 or $2, but you get the idea. Stock's price can never truly be zero, assuming we follow the efficient market hypothesis. Um, Now, what happens is when a stock price falls under a regulation set minimum, it has to begin to artificially inflate its price legally. There's a couple ways it can do it. One way is to do a reverse stock split. So let's say that it has 1,000 shares in the public float, which would be incredibly low. It has to be above $1 price per share, but right now it's trading at 50 cents. It'll say, all right, instead of us having 1,000 shares, we'll go down to 500, and the market cap will remain the same, so the stock will automatically go to $1 in theory. It's never truly that way, but that's how it works. Um, you won't really see it that often. Occasionally, you'll see that. And what that means, if you see that happen, a reverse stock split on a stock that has to remain compliant to remain on exchange, that means high volatility is incoming. Because if there was a million shares in a float and they reverse it to 500,000, now it only takes 500,000 volume, intraday volume, to completely flip the float. So any sort of sensational news or retail investor hype, or fill in the X blank, where mass people buy the stock, will cause it to go parabolic and shoot up or down. Thus, you can invest on the volatility crunch and make a ton of money. Stuff like that. That's more of advanced ways of doing it, but we can get to that in time. I go over all this on Chrono Story, so if you're ever interested, just shoot me a message, or I'm always down to talk about this type of stuff. Um, so when a company's price falls to zero, it can be delisted or gray listed, depending on what exchange you're talking about. When that happens, the exchange pretty much comes to the company, and goes knock, knock, knock. You have to remain at this volume volatility, hit these parameters made on the exchange. Nobody wants to trade you, so we're not going to keep you around. In that case, like I said earlier, companies will often panic because they want to remain compliant on an exchange. If they can't remain compliant, they'll be taken off the exchange. Now, if you're one of the investors that still holds shares in these companies when that happens, don't panic. You still own the shares, but now you just can't sell them on the exchange. You have to go find a outside buyer um, to liquidate your shares to recoup your position. Now, for me, this has happened to me a couple times. The best way I've been able to do it is just go straight to the company and say, "Hey, I have, I don't know, 10,000 shares," or is one company I had. Uh, Tell you what, if you buy these shares from me for X amount per share, uh, I can liquidate my position. And the company is happy to do that because they want to pull all their shares back in to remain in control, and also when they can go back for delisting, and it helps if they have more shares, more capital to do that with essentially, um, and not like investors flying around not knowing who's invested in what company because for accounting reasons that's just a pain. So if that happens to you, don't worry about it. The companies oftentimes will get relisted at some point in the future, assuming it's a good company for a much, much higher value than when it got delisted. And that's because just remaining compliant on the exchange is expensive. The Nasdaq alone, as we see here, it says $1 minimum, but to remain compliant on the Nasdaq, it's like $25,000 to $250,000 per report, right? Now that's cash the company could be putting and reinvesting back into itself, or giving out to investors, or hiring talent. You get the idea. So it's not a bad thing when you get delisted. Yeah, so long as the company is good and you trust the executive management and the product's good, and it's all squared away as a company. If the company is not squared away, then you're kind of screwed, because you can't liquidate it. It's just a bad investment. But good small cap companies occasionally do get delisted. And I've had some companies that have been relisted, and I've seen massive increase in capital. But generally speaking, usually when a company gets delisted, it's because it's a bad investment. Generally, companies that are at risk of being delisted should not be touched. If you don't know what you're doing. Shorting, yeah, like I was saying earlier, you can short these companies and make a lot of money. A lot of funds do that. They'll find these smaller cap companies that are floundering around trying to make compliant on an exchange. They're either doing reverse splits or what have you, and they'll destroy the company. Um, the stock, at least, they can't really damage the company, but yeah, that's basically it. When a stock's price falls to zero, it runs the risk of being delisted. Liquidity is almost non-existent, and if it does get delisted, don't worry about it. This is Chosen Day with Chrono Historia. If you like this type of content, go ahead and subscribe to both the newsletter and the YouTube channel, whichever one you feel more comfortable with. I go over all sorts of methodologies, investments, different ways you can generate above average returns in the market, alpha, in both cryptocurrency investing, everything really. I'm here to make money, and hopefully you guys are too. So until next time, I wish you guys the best of luck in your investment journey, and Chosen Day out.